Hi, I'm Jimmy. In this video, we're looking at Disney stock. So Disney stock over the past few years is clearly down a bit. In fact, Disney is a stock that I personally own. I bought my shares at about $94 and change. I think it was like $94.68 was my average price. So you can see I'm down slightly. But in that scenario, down slightly means we're kind of ignoring the opportunity cost. I could have invested in almost anything else that would have been better off than this stock over the past few years. But given how much this stock has fallen, is it worth buying today, or do I need to cut my losses and get out of this thing? Now, to come up with the answers for that, we're going to take a quick look at the basics of Disney's business. Then we're going to try to come up with an investment thesis. Is Disney's company worth investing in today at the current price? If not the current price, at what price is it good? So in order to do that, we're going to come up with a fair value for Disney stock using discounted free cash flow and ultimately try to answer the question, do we want to buy? Do we want to sell? Do we want to hold? What do we want to do with Disney stock? Now, most of this analysis is going to be done on the Investors Grow website, where we try to make it quicker and easier to analyze companies and value companies, things along those lines. But I am going to try to zoom in on most of the things that we're doing to try to keep it a bit more readable from a video perspective. But if you want to sign up to get access to the Investors Grow website, link in the description below. Okay, so these are some of the segments for Disney's business. And we can see Disney breaks their business. They actually do a real good job of giving us a ton of different numbers. But to try to simplify a lot of this noise a bit, well, we've broken it into three primary categories. We have sports, experiences, and entertainment. That is their newest breakdown of, call it the high-level segments for their business. But to really understand these segments and understand what the problem at Disney has been, and the stock being down 50% is very much because there has been an issue with Disney's business. I think it makes sense to look quickly at some of the numbers, and then we'll jump in and look at some of the individual segments and how each one plays a role in Disney's overall business and whether or not it's investable today. So this is a chart of Disney's revenue going back the past few years, about the past decade. And we can see the trend actually hasn't been all that bad outside of a slight hesitation around COVID, but overall the numbers aren't too bad. Then, when we jump over and look at the profit, well, we can see that things drastically changed. Now, of course, COVID was a primary reason, but that doesn't fully explain the lack of recovery since COVID happened. The very same story can be seen when we jump over and look at their free cash flow numbers. Free cash flow numbers were trending higher for a while, and then COVID pulled them back. And again, I have no issue with that. That happened to a lot of companies. But most companies, by this point, have recovered, and Disney hasn't. So now to better understand kind of how this happened, let's jump back to the segments, but we're going to look at it a little bit differently. So this is operating profit margins. This comes directly from Disney's financial statements. Luckily, they break out each of their segments. They give us a decent amount of numbers for each of their segments. Well, this is the past 2 years for operating profit margins. Now, overall, you can see that they're all fairly consistent, right near each other over the past couple of years, but we don't have a real comparison point. When we think back to, call it one of the last good years that they had, growth-wise, before COVID, was a year like 2019. Well, what would happen if we would add 2019 to this chart? Well, when we do that, we can see that suddenly the different segments look very, very different. So the green bars are 2019 numbers. Now, when we look at sports, we can see that the two most recent years are a bit behind from an operating profit margin. They're a bit behind where it was back in 2019. When we look at experiences have actually improved over the past 2 years. And then entertainment is way off. This is one of the huge problems. But we're going to come back to each of these as we go through the individual segments. So first, let's kick it off with the smallest segment, and that is sports. So one of the primary things that Disney is talking about doing right now is Disney's actually talking about teaming up with Fox Sports and TNT Sports, to bring a sports app, like a sports-only app, a sports-only streaming service, kind of like Disney Plus or even ESPN Plus, but with all different sports. So TNT, you got Fox Sports has like football, TNT has things like basketball, ESPN has a whole bunch of different things, but if you put them all together, in theory, if you're a sports fan, that would be the thing you want to sign up for. I think that this is likely to run into some legal hurdles. This, multi-conglomerate formation of a new company that each of them will own a piece of, but really dominate the sports market. I could see how that could be kind of anti-competitive and could run into some problems. This was just announced, or let's say the idea of this was just announced earlier in 2024. So this is a possibility, and I think that one of the problems with the sports division for Disney, primarily ESPN. ESPN is really the linchpin of their sports division. One of the problems with their sports division is this was one of the reasons that cable or live TV was actually good, is you wanted to watch live sports. Watching it live is a lot better than watching it on replay. So, a lot of the hardcore sports, fans, people like that have want to see live sports have stuck with live TV. But because those numbers have dropped down so much, it's put a lot of pressure on Disney. Now, Disney's always struggled with ESPN, what to do with it and, how to grow it and things along those lines. So I think that this combination of companies is a potential, but we'll have to see where it goes. This one is one of those, it's one of the things that's part of their business that's kind of in flux right now. That being said, when we jump over to look at their other segments, we can see their experiences segment accounts for about a third of revenue. The types of experiences that fall into this category are things like Disney parks, Disney World, Walt Disneyland, all of their international parks, their Disney cruises. If you stayed at a Disney hotel, that would fall into this. Some even merchandising deals would fall into this revenue. There's a lot that goes into this. This accounts for about a third of Disney's total revenue. And we jump over and look at the revenue for their experiences segment. Well, we can see that, again, overall, the trend has been upwards outside of the COVID years, outside of the initial pullback, and then obviously the hesitation after that. Their experiences segment has done fairly well. In fact, this is what I would have expected pre-COVID, right around when I bought my shares. I bought my shares shortly after COVID happened. Right around that time, this is kind of what I was expecting. Okay, fine, they closed down the Disney parks, and that's going to kill revenue and profit's going to go away, and I'm okay with that because it will recover. This largely did it. Now, there is one other thing to consider here, and that is that when we look at the two most recent years, you can see it's kind of out of, let's say, out of trend. The trend was moving up at a certain rate, and then it kind of pulled back and then hopped up. Was that pent-up demand, or was it other things? Things like, let's say, pricing. Well, to illustrate this, when we jump back and look at our operating profit margins for Disney, for each of their three main segments, we can see their experiences segment has gone up. The two, the orange and the blue bar, have gone up over the green bar. Green bar 20 is not 2019. See that down here? The other two have gone up, which means operating profit margins have actually increased since their pre-COVID levels. Now, one of the ways we can determine whether or not it's pent-up demand or pricing, or perhaps a combination of the two, is when we jump back and look at the growth rate for these segments. Well, looking at these segments, we can see that prior to COVID, the highest point in time here, the highest growth rate was about 10%. Not bad, but not by any means crazy. Now, that one of the reasons behind that particular growth is that Shanghai Disneyland had opened up in I believe it was in 2016, and then, ramped up, and as it ramped up, it added to revenue. So you got some additional growth when you open a new park. Logical. Then the numbers went a little bit crazy, and we're going to completely ignore these because even the big drop, COVID, the big jump, because they're coming off of weaker numbers. So we can kind of ignore this. But then when we fast forward to the more recent year, the most recent completed year was fiscal year 2023. Well, that was a 16% jump. And a lot of that was due to price jumps. Many people have discussed, I've seen many conversations happen around Disney saying that their parks are now too expensive. And they are. They did get crazy, crazy expensive. I think that one of the things that happened was as the numbers were going up and then there was a pullback in not just people that were going to the parks, but the parks got closed. And with that happening, Disney attracts a ton of people to their parks every year. And I do think that there was a certain amount of pent-up demand. And then once everything opened up, the demand kind of rushed in the door. And I think Disney probably got a little bit greedy and was able to up their prices. And a lot of people still went. I looked at the occupancy rate for 2023 numbers, and they had an occupancy rate at their parks of about 83%. Not a fantastic number, but when I looked at historical numbers, it was about in line with a decent year. So overall, they were, despite their higher prices, they were in fact filling the parks, which hopefully explains how revenue for this particular segment has done fairly well. Now, I've long thought that this is one of their strengths and one of the advantages that this particular company has relative to other businesses, specifically businesses that focus on the entertainment part of their business. And we think about a company like Disney, specifically their entertainment division. I think that there's 4 primary categories of revenue in this particular division. Think box office sales, membership signups to a platform like Disney Plus or Hulu. You've got content licensing, where DirecTV recently had a thing with Disney. They're going back and forth about having Disney channels on their platform. They ultimately settled it, and DirecTV agrees to pay Disney $2.5 billion for their content onto their platform. Content revenue has long been a staple of Disney's revenue. That's a big piece. The other part is advertising. Disney can get Disney Plus without ads, you can get it with ads. So there's a certain amount of advertising revenue. But I think that one of these strengths or weaknesses, depending on how you look at it, is Disney's library of movies. So Disney, of course, you have Disney Plus, but within the Disney entertainment segment, there's everything from the Walt Disney Pictures, Marvel, Pixar. They have Hulu. They own most of that. They have Lucasfilms. They have 20th century movies. They have such a deep and vast library. This has been something that they've been doing for like 100 or so years. So one of their undeniable strengths is their entire IP library, right? Their library is very good. It's one of the best out of all the streaming services out there. The question is, how can they properly monetize it? And this is an answer I'm not sure that they have or many companies have right now. So this is a chart of their media networks business leading up to pre-COVID. I stopped here at 2019. But we can see that between the money that they got from broadcasting and cable networks, revenue was stable, was gradually growing, was fairly predictable, and this was their baseline business. Combine this with the parks, and if you look at a long-term chart of Disney's revenue, it kind of makes sense why things were so stable for a long time. But then, as technology developed and, competitors like Netflix came into the thing, came into the whole arena, well, cord cutting, basically getting rid of cable and having to buy all of it, and instead buying individual platforms, access to individual platforms that you wanted, started to really take off. And we can see that during that time, granted, cord cutting's been happening for a long time, but it really started to happen en masse. During this time period, well, Disney's revenues began to struggle. And this is all very logical. Well, right after all of this happened, Disney Plus gets launched. Disney Plus was something that they were working for a little bit, but then the Disney Plus get launched, and everything started to change as to how we analyze Disney's business. So fast forwarding from that time point, from when Disney Plus launched, well, suddenly we started watching subscribers instead of overall revenue, or instead of broadcasting revenue or content licensing revenue. We instead started watching individual subscribers for Disney platforms. Now that included Disney Plus, Hulu, and ESPN Plus. So we can see for a while the numbers were ramping up here, and then they kind of started to stall out. Now, when the numbers during the stall out, the pullback, one of the big pullbacks that happened is Disney had Disney Plus Hotstar, which was over in India. And during this time period, they lost the cricket rights, the rights to the Cricket Premier League, I think it is. I'm not sure, I've never really watched cricket. But they lost those rights, and therefore they lost a bunch of subscribers, and their business kind of got hurt. But even ignoring that, it's kind of just trended sideways. It's just trended sideways for a little bit. Now, one of the things that Disney has said is that right now they're focusing on how to properly monetize all of this and how to properly, make it more profitable for them. so they can continue to make a lot of content, but also have that content be profitable. And I think that this is one of the big struggles in the entire industry is the amount of money it costs to make content effectively, but also grow their subscriber base is a difficult balancing act. And in my mind, this goes back to one of the advantages of Disney stock or Disney as a company in general, is that I've long believed that once all this gets sorted out, however it gets sorted out, not just with them, but with the entire industry, how are they going to do? How are they going to spend as much money as they spend on content, but also charge a reasonable price? Perhaps one day they end up combining everything and, calling it cable or something like that. But either way, I think that in time, a lot of this is going to be shaken out. But I think that Disney's advantage, one of the reasons that I liked Disney when I first invested in it, was that their advantage was they have other, let's call it supporting, parallel businesses like their experiences segment, which generate, frankly, a ton of revenue and a ton of cash flow. And that cash flow can be used to fuel some of this. The fact that their entertainment business for a long time has been unprofitable. Well, for the past few years, ever since they launched Disney Plus, it's been unprofitable. They have the luxury of doing that because, frankly, their other businesses kind of support that. Well, with that in the back of our mind, and when we jump over and look at revenue, but now with analyst estimates added to it, we can see that analysts are expecting for revenue to gradually grow, although not at an extraordinary pace. And then when we jump over and look at free cash flow, well, free cash flow doesn't look quite as, let's say, robust as revenue looked, but analysts do have it jumping up a decent amount and kind of stabilizing at this level. Now, I think one of the real questions a lot of people might ask is when we look at their free cash flow numbers, why do we believe or how confident are we that their free cash flow number is going to jump from, let's say, the 2023 level, which was just short of $5 billion? Why do we believe it's going to jump up to $8 billion and then stay there? Well, one point to consider from will free cash flow do that? I'm not sure if free cash flow is really going to get to $8 billion. But when I looked at the first 3 quarters of fiscal year 2024, their first 3 quarters are already about $5 billion. So they got to do about, if my math is correct, somewhere around $3.4 billion in the fourth quarter of this year in order to achieve the estimates of $8 billion. Coincidentally, the fourth quarter of last year, they put up about $3.4 billion. So are they going to do it? I'm not sure, but I do think it's very possible. And then analyst estimates going out the next few years, they don't exactly have robust growth, but the growth is there. And I think that once Disney is able to sort out how they're going to properly monetize and maintain the profitability of their entertainment business, I do think that Disney has the potential to be a good investment over the long run. The real question is, at what price? Now, when we jump over and look at a discounted free cash flow calculation for Disney stock using those free cash flow estimates that we just saw, well, we get a fair value of Disney stock of about $58 per share. The stock is trading at about $94 per share. So clearly, right now, Disney stock looks overvalued based on the current, call it the current growth of numbers. Now, just so we're on the same page, the free cash flow estimates that we showed before, the assumptions that I make with that is after that, Disney will grow free cash flow by about the rate of inflation. So by about 2.5%, or let's say the target rate of inflation, by about 2.5% from there on out. So I take fairly conservative numbers to it, but still, the stock looks fairly overvalued. Now, for me on a personal basis, I already own shares. I would not buy them today. I will not buy more shares today. I already own them. If this stock pulls back a decent amount, I might average it down my average entry price. I might buy some more shares and bring down my average entry price because I do believe that Disney is a solid business over the long run, albeit I can see the risks in it. So for me, I'd also want a decent margin of safety. So sticking with this $58 fair value, well, I'd probably want to add a 15, maybe 20% margin of safety on top of that. So with that in mind, we're kind of a long ways off. Unless there's something drastic changes, we're a long ways off before I jump in and buy more shares. Now, I have no intention of selling my shares at this point, just because, again, I'd be about break even, so there'd be no real tax benefits for doing it. And Disney is a business that I believe in over the long run. Now, if you want to sign up to get access to this website where we have a ton of analyst estimates, cover thousands of companies from around the world, quickly and easily calculate the fair value for individual stocks to help guide you as to whether or not a company could be a good or a bad investment, I will leave a link in the description below. I got a link right here. And if you're curious how to analyze companies, I actually did a video called 8 Steps to Analyze a Stock. Video right there. Link in the description below for that video as well. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.